The best way to use a tax refund.
Yeah, Brian, I'm excited about this one because this is one of those shows where we get to really speak to financial mutants. Because oftentimes I feel like tax day rolls around and people get excited. They're like, oh, I'm getting some free money. It's coming back my way. And we might encourage a financial mutant to possibly think about that a little bit differently.
Well, we're in April. Look, April is one of those times where there's several exciting things that happen in April. You have the Masters come to Augusta, Georgia.
Yep.
You also have the tax deadline of April 15th.
That's
so
right.
It's one of those things where we definitely want to kind of let you know how you should think about this. And I think we did some research and we found that 76% of returns that Americans file do indeed have refunds. So let's come up with a better plan so you kind of know how to get the most out of every dollar that comes into your possession.
Now, there was something interesting, Brian, that you said is you were like, you asked Daniel, I don't remember what it was. Maybe it was yesterday, maybe it was this morning. It all kind of runs together to me. You're like, hey, I wonder when do most Americans file their taxes, right? Because, obviously we, one of the things that we do for our clients is we review tax returns every year, right? Well, some clients, they email us like February 1st. Hey, I got my taxes done. I'm ready to do it. And some clients email us like on October 14th, asking us to review their taxes. Talk a little bit about what you figured out when you and Daniel had that conversation.
Well, yeah, I said, hey, you know what? We're big researchers here. I'd love to know, when do people actually file their tax returns? And remember that key stat I just shared is that 76% of Americans actually get a refund. Well, wouldn't you know it? People are obviously in a hurry to get that money in their possessions because you see 44% of returns are actually filed in the month of February, 25% in the month of March, 16%, making it by the April 15th deadline. And then there is about 15% that said, hey, I don't know, or these are the extenders. So you can quickly see, if you add the 25 and the 44, you're at 69%. A good chunk of that 76% are trying to get that money in their possession as fast as possible. And I actually like people doing returns early if you can, because that gives you two options. It lets you know, hey, if you owe money, how are you going to come up with that money? But if you actually have a refund, it gives you a chance where you can watch content like this and know, how do I maximize what to do with that? So let's kind of jump into these, Bo.
So I think this is interesting, Brian. You and I were talking in pre-show, and you're like, but I don't know that I agree with how we set this up. Like, the thing that you, like the number one, I think maybe the number one should be number 4. And I think that's interesting. That's gonna be a neat little dialogue for us to have, because we said one of the first things you can do if you are someone, when you file your taxes and it turns out that you're getting a refund, you're getting money back, is you can actually apply it forward. You don't actually have to receive a refund. You can apply it to next year's taxes. And you said, but that's not what the majority does, but why would that be the first one that we put in there?
Well, look, I love the Money Guy family because I know we're talking to aspirational financial mutants as well as full-on financial mutants, and this is because we always talk about maximization strategies, and when you start talking about applying, because by the way, it goes from being a refund to an overpayment.
To be an overpayment.
Because
That's
there's a
exactly
huge difference there. They're kind of the same. They're on the same tree, but it's just because refund sounds like, hey, the government's sending you back your money. Overpayment means that you are keeping track with the government. Instead of actually taking the refund, you're just saying, hey, you know what, business partner, Uncle Sam, you just take that extra overpayment and just apply it to next year, and we'll keep this ledger up. And this is why I said it's weird to do this one first, because this is for the financial mutants that are probably in that estimated tax payment category. Because once you reach a level of success, your income goes up, the government is going to start requiring that if you don't pay in enough money, you get underpayment penalties.
That's right.
And they can be kind of hefty if you're not really keeping track of what's going on. So that's why you start making estimated tax payments.
So you said underpayment penalties. How does someone, because I imagine a lot of our folks out there, maybe you have unique job circumstances or you have fluctuations in income. You think, I don't want to run into an issue where I have an underpayment penalty. Talk a little bit about that.
Yeah,
and
let's
how you
talk
can
about
stave
people
that
that are not in that category that the government thinks you ought to make sure you really pay them extra money or get it in there on time. Is the people, if you're single under 75,000, or if you're married filing jointly under 150,000, really your threshold is you need to have 90% of the total tax you owe, or 100% of last year's taxes paid in. That will keep you out of trouble with the government. But there is a big distinction. Once your income goes up, they're going to say, look, you better make sure that you've paid in at least 110% of last year's taxes. Now, the good news is, like, you come into a large sum of money, or you get a big bonus, a commission, or you sell some property and you have capital gains and other things, you can go take last year's taxes, pay 110% of it through estimated taxes or withholding, and you'll get yourself out of a lot of that trouble. You just have to make sure you do pay the full obligation by April 15th. But I do like talking about overpayments are a great way, and I even have an extension hack on this.
I was wondering if you were going to share this.
Yeah, I mean, because this is a game I've been playing for years, is that, like, I feel very comfortable that I think for my 2021 tax return, I've paid in enough through estimated tax payments. But I'm always a little nervous because there's a lot of things, because owning several businesses, my income fluctuates greatly, and I've done tax projections, but there always can be that oopsie, or wow, that came in a little differently, because we even have, like, some with owning real estate and commercial buildings, depreciation hits in different ways. So I have a little inside tip on something I do that you can consider doing as well. I have to make estimated tax payments. I've been in business with the government for years now, where I no longer get refunds. We just trade money back and forth with each other. And what I've done is, instead of making first quarter estimated tax payments that are due by April 15th, I actually do an extension payment of $48.68. That's the form that you do an extension, but we do it through the direct pay.
Nice flex.
And I pay it towards the 2021 tax return, or the previous year's taxes. And that way, when my taxes are actually done, because they're extended right now, because you get an extension to file, do not get an extension to pay, I will have a little extra protection. I think I've paid, so every bit of the money I paid with that extension payment will then get applied to the current year's taxes. But if, just in case there is an obligation that I missed, or I will be covered for last year too. It's just it's kind of a nerdy way to protect yourself.
Can I paraphrase what you just said?
Yeah.
All right, so what you do is, instead of making a first quarter estimate, you just way overpay last year's taxes with an extension payment. So your refund is going to be much higher, and then you'll apply that much higher refund to this current year.
Yeah, that's a good way to put it. And here's why, and we'll move on to the next point, because I want to make sure for the people who haven't reached that financial mutant status that they can do it, they're more on the aspirational, is that I think that this is important because it just allows you to, not get the, oh my goodness, because I remember when I was doing taxes for all those 16 years, that the worst phone calls as a preparer was calling that business owner who struggled for years, and then all of a sudden they start really getting traction with their business, their income's going up, and then you call and say, hey, by the way, you owe $46,000. And they're like, what? Oh my goodness! How could where am I going to come up with 46,000 or 73,000? Because that's what happens, is that you're putting along, and then all of a sudden your company starts getting traction. That's when you and Uncle Sam are become really close business partners.
All right, so number one that we came up with was, with your tax refund, you can apply it forward. Here's number two that we thought about. Maybe this tax refund, rather than being something else, it can be a mechanism to help you start paying off some debt, to help you start retiring some obligations. And and if you've been listening to us for any amount of time at all, whenever we have money come our way, whether that be through income or through a tax refund or through an inheritance or through lottery winnings or through whatever source that dollars might come your way, we think there's a tried and true system to help you start working through how you should deploy those dollars. We call it the financial order of operations. We've actually developed an entire curriculum around this. You can go to learn.moneyguide.com and have our course where we walk you through the financial order of operations. But one of the very first things on the top row in the first 3 steps is satisfying high interest debt. So if you are someone who is getting a tax refund back and you've covered your deductibles and you're maxing out your employer match, but you do still have some credit card debt sitting out there, or some consumer store debt that's high interest, or some other type of high interest debt, your tax refund may in fact be a great thing to use to go ahead and knock that out, do away with it, get rid of it forever.
I've got kind of a debt that sits in between that high debt and then the low interest debt that we'll talk about with mortgages and so forth. But car loans, because a lot of people also, you could use this refund if you're one of those people, because the 23.8, we talk about this all the time. Vehicles, I know right now we're in this unique time where trees are growing to heaven and cars are appreciating, even used cars. This will not last. So make sure that you are paying respect to the fact that cars should be paid off in 3 years. So if you've got some big 6-7 year car loan, and the interest rate's going to do something that could be detrimental to you financially, this might be an opportunity to take care of that.
Absolutely. So if we're going to talk about things like debts to pay off, I think, Brian, it makes sense for us to pay a little homage to debts that maybe we should not pay off. One of those, you already mentioned, low interest mortgage debt.
Yeah.
If you are someone and you've not advanced in the financial order of operations, that you're all the way to step 9, and your tax refund comes in, you might not think, oh, great, I'm going to make an extra mortgage payment. In our opinion, our view is there might be a better way for you to deploy those dollars. Well, I think a more realistic thing that a lot of folks are thinking about, especially right now, Brian, in this world that we live in this moment that we live in, a lot of the folks that we're talking to, a lot of the folks that are reaching out to us, that are calling us, are asking about student loans. Hey, I've got this student loan debt. I have this thing. I have this burden that's weighing me down. Should I, if I get a tax refund, should I just immediately apply that to my student loans? Should I let that be something that I go take this and try to satisfy to just get that burden off and away from me?
Well, we tried to come up with, because student loans is a new, what do you call it, a burr in your bonnet or whatever. It's just something that's driving me crazy, that the amount of debt that students are coming out of school with right now. So I don't want this thing, because it just hangs over you like a cloud, keeping you from living your best financial life. So what we like to tell people is, look, make sure you know what the interest rate on your student loan is, and is it going to change? Is it variable, or is it locked in? Assuming it's locked in, then now you can move on to the step 2 of the analysis and figure out, is this something that, based upon my age, that maybe if something's below 6%, if you're under 30, if something's under 5%, if you're over, if you're under 40, then these things you can classify this as lower debt, because you think the spread on your army of dollar bills, meaning the money you're going to invest, is going to do better. You get a little more flexibility in how you can pay off and versus investing.
Yeah, I'm going to say this. I'm going to say something differently, and this just hit me. This hit me on the spot. We talk about in the financial order of operations, low interest debt. What I'm recognizing as we talk about student loans, Brian, is that low interest debt means different things depending on your age, right? Wouldn't you kind of agree with that?
For sure.
Low interest is different to someone in their 20s versus someone in their 40s. So when it comes to student loans, you have to approach it appropriately. I'm going to say what you said again. If you're in your 20s and your student loans are 6% or less, you probably don't want to prioritize paying them off, because your dollars could likely be better used elsewhere. If you're in your 30s, the number goes to 5%. In your 40s, the number goes to 4%. And by the time you get to your 50s, hopefully your student debt is all gone, and you're likely now thinking about, how's my next generation going to pay for college? How are they going to go get a higher education?
Yeah, and look, I don't want to belabor this, but I had a great conversation with a really close friend this weekend. I have a senior in high school. Hey, make sure you're talking to your kids about what a struggle student loan debt is as they're choosing their majors, as they're choosing where they go to school. Because I think sometimes when you're, 17, 18 years old, you're more thinking about the funness and what the next 4 years, 5 years of your life are going to be like. I'm thinking more long-term, was the next 7, 10, 15 years of your life look like. And if your job, that's why we have the guidance of, don't come out of college with more debt than you're going to make in the first year. Now, look, there's exceptions with like professional degrees,
sure,
like attorneys and doctors. But if you're coming out of school with a 4 or 5 year degree and that's all you're doing for education, you're putting the old, learning shoes up on the shelf, then you make sure that you're following that, because you do not want to have debt that's following you around forever.
Now, I read an article this morning, Brian. I know you love it when I bring stuff up that we haven't talked about previously. It makes it all kinds of fun. It was this great article, and what it did is you can search for universities, and then you can search for the major program, and it will tell you, based on that major, what the starting salary is at age 25, and it'll show you what the average salary is at age 45. And it calculates for you a return on investment on that degree. So I think we're probably going to develop some future content around that. So I've got a relative who's going off to a school and I'm having this conversation. I went and looked up the major and looked up the salary, and the return on investment was like negative a six-figure number. So it's like a really interesting conversation to have. Those tools are out there. If you are counseling a young person, if you are a young person thinking about taking on student loan debt, figure out what your return on that investment is and determine, is it actually worth it?
Let's talk about, because I'm finding myself wanting to go into this next realm because it ties into financial order of operations. Number 3 is really boosting your army of dollar bills.
That's right.
You know, we're in this crazy inflationary period and people are like, how do you battle this? I'm like, own stuff. And one of the best ways is, you know, getting investments, starting your path of building wealth. And, you know, and I know we sound like a broken record, but it really is a all-terrain, all-weather type system, and that's the financial order of operations. That's why I love, because it lets you know what to do with your very next dollar. Yeah, we covered. You're going to make sure you pay off that high interest debt. But what I like is step 4 is making sure you have some emergency reserves, that rainy day done right. And then step 5 is, you know, making sure you're maximizing the tax-free growth opportunities that the government provides for us. That's your Roth IRA, your HSAs. The biggest thing is you need to understand that every dollar that comes in your possession, especially when you're a billionaire of time, realize every one of you guys that are in your 20s, you are so wealthy with the amount of time you have, and that is the most important ingredient with wealth creation, because you set it, forget it, and watch. You put that money in the right place, you're going to be shocked at the compounding growth and what it can do. So we've actually created a great deliverable. Go to moneyguy.com/resources, and we actually show you what every dollar has the potential to become by retirement. Use this as motivation so you can really decision, you know, go look through each one of those incremental decisions to look at the opportunity cost versus the potential of what it could become, and use that to really make the good decision for yourself.
Once my friends figured out that I was in financial planning and this for a living, starting probably around the age of like 22 for me, friends would start asking me to help them with their taxes. They do TurboTax, help me go through it. And I can't tell you how many times I do the taxes and they'd get like the retirement savers credit and a child tax and all these credits that came back to them. And I say, okay, great, you got a refund. What are you going to do? And the answer is, I've been wanting to get a new car. I'm going to use it as a down payment. Or, we're going to take that trip. We want to do a weekend trip. Or, we're going to fill in the blank. I wish I could go back in time and just hand those people this form. Hand those people this thing showing how powerful those dollars can be. That tax refund, maybe it's a couple $100, maybe it's a couple thousands of dollars, but it can turn into tens, if not hundreds of thousands of dollars for you later in life if you can put it to work. I wish I had a time machine. I could go back and fix that. And you, listening to the show, you have that opportunity to do that right now, today, with your tax refund.
You know, it's been a few months since I finished this chapter of the book, but it's I know that over my career, I've missed $10,000 of IRA potential, meaning I just, because I was starting the business or something, where I missed $2,000 this year, I missed $2,500 another year on my IRA contributions. The opportunity cost now that I'm getting close to 50, guys, it blows my mind just missing out on $10,000 over like a 4 to 5 year period because I was starting the company has turned into a lot of money. And I detailed that. Don't have those regrets later. Really use, especially with a tax refund, if it's several $1,000s, don't go use that money on a consumption thing like a vehicle, like you mentioned, no matter how crazy it seems right now with them going up. Use it on something that you're going to look back in your 50-year-old self and be like, thank goodness I had the vision and the thought to let that $2,000 refund go into a Roth IRA and really benefit my family and my future self tremendously.
Here's the fourth thing that you may want to think about doing. Perhaps you're someone who gets a refund every year. You're like, yeah, I like it. I feel like I'm getting free money every year. What you might not recognize is when you get a refund, that's most often not the government giving you money. It's the government returning money to yours that likely was yours to start with. So all you've essentially done is given the government an interest-free loan on those dollars. So if you are someone every year when you file and you are getting larger refunds, perhaps you might want to think about adjusting your withholding out of each paycheck so that your refund is smaller, so you actually get to use those dollars throughout the course of the year, instead of, loaning your money out to the government interest-free.
By the way, to make that happen, all you'll do is go to your employer, ask for a new W-4 form. That's the new withholding form. And you can even do as simple, I think it was like box 3 down at the bottom. You just say, hey, I need an extra $250 a month.
That's right.
Taken out, or, lower. You could even change, maybe you did 0 on what you put in on that W-4. Maybe you could go put the kid, you want to consider your dependents, or you want to consider outside income, you can put those things on that W-4 form. I went ahead and immediately rolled into, because I've had this discussion with several employees here, and this is, as an employer, this is a good thing, but it's also like, because some people are like, they do their taxes, it's the opposite. We're talking about refunds here, but there's a lot of you that might be like, wow, I owed $6,000, I owed $10,000 with my taxes. How do I make sure that doesn't happen next year? The same form, W-4, you can have a little bit extra taken out of that paycheck. You'll get very familiar with this process as your income keeps going up, because you always, like I said, your business partner is the federal government. You need to make sure you understand the rules so that you stay, in good standing. Because, by the way, your business partner, the federal government, is called a drag-along partner, meaning that if they don't like what you're doing, they just can come take your stuff.
That's exactly right.
So you need to be very careful with how you deal with this big bad gut partner that's you're in business with.
All right, so after you have thought about, do I apply this forward? Should I pay off debt? Have I bolstered my army of dollar bills? Do I need to adjust my withholding? After you've gone through all of those things, then the last step of the best way to use your refund is to then go have some fun with it. Again, just like most things in your financial life, once you've checked the boxes to know that you're doing the things you're supposed to be doing, you can go make decisions guilt-free. So if you've done all these things and you do get a tax refund, say, man, maybe I do want to go on that vacation, or maybe I do want to buy that thing I've been waiting on, or maybe I do want to upgrade my phone, or whatever that thing is for you, it's okay to do that if you know that you've done everything you were supposed to do up to this point.
That's what I love about our job, Bo, is that a lot of people, I think they think, hey, if I go hire a financial planner, these people they're just going to be like that meanest coach on The Biggest Loser, where they're just
yelling at
you
me,
down, yelling at you,
more.
not letting you have fun. It's actually just the opposite. If you can put in the sacrifice in the beginning and do the work, that's why we love the financial order of operations. It actually gives you a path forward that there will be a point. And for some people, it's going to be in your late 30s, and others, it's going to be your mid 40s. But you will get to a point where you've checked all the boxes. Now go live your best financial life guilt-free. And that's what I love about our job. We get to tell people all the time, go out there, kick it up a notch. Go enjoy that vacation. Go make memories with your family. Okay, it's okay. You can start driving a little bit nicer vehicle now. And people are shocked, like, wow, this is great to go actually use these things for, not just the resource of building for the future, but also just because I know I've covered all my bases. And that's the part, because I think I see a lot of the YOLO crowd says, hey, tomorrow is not promised to me, so I better live for the now. More than likely, you're going to live to a ripe old age. So I like the balanced approach of that. Yes, let's take advantage of the 3 components of wealth creation, which is obviously discipline, money, and the most important, time. While you're a billionaire of seconds, let's make sure that you are investing that money. But then we're going to give you enough time, in your 30s and 40s and beyond, that you get to enjoy decades of your life because you made that sacrifice earlier. Don't miss out on that opportunity to go build resources, but also live your best life and have fun with your resources as well.
And so you guys know, one of our very favorite things to do is we like to answer your questions. We want to load you up. So right now, if you're in the live chat, I have a team out on the wings, Daniel, Nate, Katie, and others, pulling in questions for us right now. So if you have a question, make sure you get in the chat because we're going to load you up. At the end of the day, the reason that we do this is so that we can help add value to your financial life. That's the first part of the abundance cycle. So if you have a question, get it in there. And Brian, let's jump right in. This first question is from Isaac. Isaac says, am I correct in thinking that with increased interest rates, this will help push home prices down in order to keep those mortgages feasible? Therefore, I could, and I'm going to say the word should, expect a decrease in the value of my home. I feel like a lot of folks are asking this question right now. Hey, I'm going to wait for the crash. I'm going to wait for the crash. I'm going to wait for the crash. As interest rates rise, the market's going to crash. One, is that a certainty? Two, is that the way that it always happens? And three, if you are someone thinking about either the value of your current home or potentially the value of a home you might want to be getting into for first-time home buyers, what advice or what counsel would you give them about this market and what's unique? And because I just want you to dispel some myths and some rumors.
Yeah,
possibly.
and look, this is nuance. This is why people hire financial planners too, to help them kind of go through this. But I don't mind sharing some of the tea leaves that we've read here at the office. Is that, look, that is directly why interest rates going up is supposed to cool off the market. But I think there's some additional things, some other factors that you need to take into account. First thing, where do you live? If you live in a state where the migration patterns are tremendous right now, like we live here in right south of Nashville, Tennessee, there are tons of people piling in from, California, Chicago. That's half my neighborhood, it feels like, so it's everybody's piling in. There's these huge migration patterns. So when I'm talking to some of our primary advisors here that are trying to make some of these big decisions, I said, look, I don't know, just looking at historical trends in the past, like in the collapse of 2008, Georgia, South Atlanta, where we were, got beat by 50%. I mean, but that was a supply. We had an overabundance of housing supply, not enough buyers. We have the exact opposite now. There's just not a lot of inventory out there, and but there's a lot of demand for people, especially when they're moving in. So yes, the interest rates going up could have, in a city like Nashville, could cause the market to have a slight adjustment of losing 5, maybe even 10% of value. But I don't think you're going to, if your team crashed thinking you're going to see a 50% drop in value, that's probably not going to happen. So you need to curb your expectations to a degree. Now, look, I was talking to another client who's thinking about they want to do a secondary home or a vacation property down in Florida. And look, I think there are migration patterns. A lot of people have moved to Florida, but Florida has something different than what like we have here in Nashville, is that they build these huge skyscrapers on the coastal area. And that's what, if you paid attention to the last housing downturn, a lot of the big collapses occurred in Las Vegas, Florida. It's all these places where they build these huge skyscrapers of condos and other things where, once again, pay attention to the supply of the area. If they overbuild, then you can count on a bigger collapse or a bigger correction when interest rates go up. So that's what I'd tell somebody, to pay attention to the trends there. Right now, we don't have a lot of inventory, so there's a lot of insulation from team crash ever getting their wishes. But if that changes, as interest rates go up and there's been overbuilding as people are trying to catch the supply problem, that might create an opportunity. But I think it's more important, and I'm going to leave some room for Bo to talk about this because he does a good job. I'm trying to give you the pontification stuff. Bo will give you the fundamentals of, you need to really figure out the why more than you do some of this ancillary stuff that I'm trying to give you just a basic understanding of.
Yeah, I think what's really interesting, and we often forget this, is that a home is supposed to be a use asset. It's supposed to be the place where we lay our head down at night and we spend all of the time that we're not out doing other things. That's what most of us use our home for. Well, financial mutants, we tend to have a really hard time with not perfectly optimizing. Brian, we've watched this in each other over the years, with both of us just wringing our hands over not making the absolute optimal financial decision. When it comes to a house, there's a chance you're not going to buy your house at the absolute best, bottom, perfect price. And when you go to sell your house, there's a chance you're not going to sell your house at the absolute top, perfect price. That's okay. If you answer the bigger fundamental questions of why am I making this change and what's my timeline, it will remove some of the I did it wrong. A lot of folks right now are saying, man, I just don't want to buy into this housing market. Everything is so expensive. Everything is so frothing. Everything is so inflated. And I have to remind them, hey, do you need a house? Yeah, no, I need a house. You trying to grow a family? Yeah, I need to grow a family. Are interest rates at a decent place right now? Yeah, they are. Okay, so if you overpay for your house, but you plan on living there for 7, 8, 9, 10, 12, 15 years, odds are time will correct if you did overpay a little bit, or if you're trying to sell your house, but man, I just think this thing's gonna keep running. Well, do you need to simplify your life? Do you need to not have a property that you own somewhere else that you have to think about and take care of? It's okay to not maximize every financial decision. The finances, money in general, is nothing more than a tool to help us do the things that we want to do and focus on the things in life that are really, really important. Don't get yourself so caught up and wound up in making the absolute perfect decision that it stops you from making any decision at all. Because I feel like we're seeing a whole lot of that right now.
Yeah, analysis paralysis.
Analysis paralysis.
You know, that's why I think, Bo, and there's a big distinction there. Your primary residence mean the residence that you're raising your family and you're going to be there for an extended period of time. The longer your time horizon, the more grace you get and how bad the decision can be. So now, you know, so use that. Now, secondary housing and other things like that, or even investment property, you better pay attention, because the purchase price is going to determine how well you do on that property. And that's why even discussions with my own wife, I've explained to her when she's talking about, hey, we got to consider a place in Florida. I'm like, nope, we're going to wait and see if they overbuild. You know, that's kind of what I'm doing to see.
I think that makes a lot of sense.
And that way I'm just keeping, you know, my money working, and we'll just see how this plays out. Because I've been here, done that, and I'm going to be paying attention to things.
Awesome. Isaac, that was a great question. Brian, you want to add? So what's great is there's a lot of tax questions coming in.
Okay.
Do you mind answering like some sort of nitty gritty tax questions?
Oh, sure.
This is a timing one, and I know that you just had a lot of experience with this. This is from Kevin. Kevin says, my annual bonus has a much larger portion of taxes taken out than my typical paycheck. Is this common? Why is this the case? I'm going to expand his question a little bit, because we have clients all the time who they'll get a big bonus in the month of December. And when it comes time to do their taxes, we go and there's a huge underpayment. And they're like, what happened? Why did this take place? Can you talk a little bit about how taxation is done from a payroll perspective, especially when you have like fluctuations in income, and then maybe just bolt on at the end? Hey, if you're someone who's in this situation, what are some strategies you can employ to try to like offset that?
Yeah, you know, we talked about earlier in today's show, estimated tax payments, but the best way to pay your taxes, because the government gives more grace to this, is withholding. So, you know, and the most popular way to withhold is out of your paycheck. You know, you work, they pay you, a portion of that pay goes to the federal government and the state governments for tax withholding. The reason that is the favored way to pay your taxes is because it doesn't matter if you withheld that taxes on January 1st, if you withheld that tax on December 31st, the government treats whenever that withholding was done almost like it was just paid on January 1st. They give you credit for the full year and minimizing taxes. So you can already tell, since the government's doing that, there's some type of quasi-projection or use of withholding. So when people have variability in their pay, and you can imagine, because we run payroll once a month here, and I'm such a nerd.
You're still the payroll guy.
I'm such a nerd. I just have not, outsourced or given away that responsibility yet. Because there's part of me as a business owner, I kind of like paying our 20 plus employees and seeing it and feeling that fulfillment after I hit the submit button and knowing we had the money to cover it. But it is one of those things where when you're withholding it, your income fluctuates. They're kind of making some assumptions on what your income is based upon what your pay is that month and how it will continue. So in the payroll systems, if you have a big bonus that comes in and it's just going off your default payroll instructions, it might push you into, the system might say, wow, this at this earnings level, they're going to be in this tax rate here, this marginal rate, we better withhold extra. So you see a big chunk of money withheld out of that because they're kind of essentially, in a way, annualizing your income at that much higher level. Here's what I tell people, especially on year-end bonuses. some great planning opportunities. First, go to your HR department, whoever's in charge of your payroll, and say, look, I've noticed in the past I'm getting huge refunds, and it's primarily driven by the big withholding that's coming out of these big bonuses. I'd like to know if there's any ability for me to come to you and we do some custom withholding on that year-end bonus. And especially if you're an executive level, you might find that this has a lot of opportunity because, first of all, it lets you do several things. Maybe your 401k withholding needs to be a little different on bonuses than it needs to be on, on normal pay, so that you can make sure you maximize. You're reaching step 6 of the financial order of operations, where you're maxing out your retirement options. The other thing you want to ask them is, hey, can I do a tax projection and tell you specifically what to withhold out of that big annual bonus, both for the federal government and the state government? And a lot of times employers do have that capability to do that if you're just proactive and you don't wait until the last minute. You need to be very proactive with this, because most financial or accounting type people, they'll do anything in the world for you, but they just don't like procrastination, because that puts more pressure, more stress on them, because it's hard to move mountains very quickly with this stuff. So an ounce of planning will really go a long way on this, and I think you might be surprised that this will help Kevin on making sure that you're not getting those huge refunds because of bonuses, or maybe they're under withholding. This covers you both ways.
Here's a little piece of free advice. If you're truly a financial nerd, a financial mutant, right? Take last year's tax return and just put it on a spreadsheet, like all the things he had: wages, dividends, all credits, all the deductions, whatever you had. And then kind of compare that to this year, right? And you can kind of do a very simplified tax projection for yourself. And if you are someone, you think this is going to be a big year, I'm going to get a big bonus, go ahead and drop that in and see what it does to your marginal tax rates, your effective tax rate, and see where that puts you. And let that be your guide, especially for someone who gets paid like quarterly. And that way, we have clients, sometimes they have to make quarterly estimates and sometimes they don't, depending on how the years are going. A little bit of preparation early on, and it's not incredibly complicated. If you understand how to look at a tax form, you understand how a spreadsheet works, you can do this. I don't think it's crazy to kind of keep like a running total throughout the year to see if that makes sense.
It's so funny you said that, because that's exactly what I did. Was I went and grabbed last year's tax return. Yep. Then added up all my income sources. I compared the two, figured out the difference, multiplied that sum by my marginal rate. And I was like, okay, what did I pay in taxes?
How close
Added
am I?
those two together, and then I subtracted what I'd made in estimated tax payments. And I was like, all right, this will be okay. And so that's what Bo just described is a good, easy way to kind of conservatively estimate what your taxes are going to be.
Awesome. All right, Brian. So here's the next question. This is from Gregory. We talk a lot about student loans. We talked a little bit about it even in the segment earlier. Gregory says, I'm an MD, medical doctor, in a good spot now, but it took a lot of debt to get here. How much should I put in a 529 per month to make sure my child, who's due in August, will be in a better financial spot to pursue their dreams? So this is really the crux of his question. Hey, I went to medical school and I had to rack up all this student loan debt, and I recognize what a burden that is for me. My child, in utero, about to be here, I want to set them up for better success. How should I think about saving for college? How should I think about doing a 529? What considerations should I make? I just think, Brian, we've worked with clients who've had babies. We've worked with clients who have now sent kids to college. You yourself have had babies, and now you are sending a child to college.
Yep.
I think it's some interesting perspective. What advice would you give Gregory, the expecting parent?
Greg, I'm going to kind of load you up with some of the variables that go in this, because it is very unique for every person that comes into this decision-making process. The first thing, because we're financial mutants, is, what state do you live in? Because every state offers 529s. They're not all created equal, but if you might live in a state where they incentivize you to use the state 529 there, and you can actually get a tax benefit. We're originally from Georgia.
Yep.
Georgia has an $8,000 per year per beneficiary state tax deduction. That's like a guaranteed 6% rate of return on your 529. So you need to know that number first to kind of know, well, hey, that's something that's kind of a cool benefit. Now, there's a caveat. There's an asterisk next to it. realize Georgia is also one of those states that if you contribute and take advantage of that $8,000, it goes to get that 6% state income tax to, benefit. They have, if you move away and try to send this to another 529, they go, ooh, not so fast. Remember, we gave you that tax benefit. They kind of pull it back. So pay attention to those rules as well. So tax benefit's important. Also, Greg, you need to make sure, hey, what are the education goals K through 12? Because 529s now can also be used for private school, K through 12, plus college, because that's going to obviously, you might want, if you can afford to do it financially, it might make sense if you're going to send your kids to private school that you're going to load up these 529s. So in a tax favored way, you're saving not only for college, but also K through 12 education. So that part of your why question needs to be answered. And then there's a fundamental question all parents have to ask themselves. How much participation do you want to have in the education? Because I have some parents, like one of my friends this weekend, we had a lot of, conversations because we do have kids that are seniors in high school, was like, I've sat my son down. I showed him what we had in 529 assets. And I said, look, your decision on where you're going to school is going to be impacted by this because you go to this community college that's, in the next
super
town
affordable,
over.
yeah.
I think we got enough to cover it all. So you're going to come out of college with zero debt. If you go to the state university in college, you probably going to come out with, a little bit of student loan debt. If you go out of state to this college that you're considering, we can cover the first year, but years 2, 3, and 4, you're going to have to run student loan debt on it. That stuff is, and then by the way, that's not the end of your conversation with your child. And look, I know it's weird because your child's due in August, so you're not having these discussions
maybe
yet.
Talking to the belly right now.
You're not having this because they can't make those decisions. But you do need to, and this is important for Greg to understand, because I want you to be that parent that's also trying to teach your kids the critical thinking skills to figure things out. Because there's a reason, and I copied the whole Dave Ramsey thing where I made my daughter, or I requested or required her as part of the process. She paid for half of her car.
Yep.
And there's a reason I've also primed the pump where funded a custodial Roth when she started working by giving her a dollar for dollar match on what she contributed to that, because you're trying to create these young financial mutants that they kind of understand what the value of a dollar is. So when they get to college age, they don't just go, man, I know that university has a great reputation of just being a fun place to go. So I'll go get a degree in something that, it only pays, a small amount when I graduate, but I'm going to have a great time for those 4 years. And a lot of my friends from high school are going to go there. We're going to make some incredible memories. Realize these kids don't know what they're getting themselves into in the long term, so it's your job to go ahead and help them prepare. Now, I'm bringing it back to Greg because he's not saying, hey, I'm not trying to just do this. I'm trying to know what's the amount I need to start saving. I'm a financial mutant. You kind of have to go through those things, and then it gets to be just a nerdy financial calculator discussion, and you can figure out, hey, do I want to put this all into 529, or do I want to put the majority into 529 and maybe then do a custodial for some of those life things like the new house and so forth? That's the fun stuff. I kind of had this thought, because I was worried because realized that my kids were all born before you could use it K through 12. And I didn't know at the time that my youngest was going to be, special needs and, and probably need help, and the ABLE accounts would come into account. So I just went with a very reasonable amount that I felt comfortable with, and I've just kind of stuck with it, the whole time through.
Yeah, I don't think you said this. The only thing in my opinion, the cost of college and the way it works has to change, right? It seems to me like it likely will change over the next 18 years. So if I were to go take the cost of medical school today and inflate that out at whatever college costs have been inflating at 7-9%, the sum will be overwhelming. Well, if I start adjusting the decisions I'm making today to try to fund that future bill, I don't know if that's like completely grounded in reality. So I love what you said, Brian. Pick something reasonable. Maybe I look at the average cost of public school, or the average cost of private school, or the average cost of in-state or out-of-state, and kind of figure out loosely what I think that, 4 years or 6 years or however long it will cost, and pick some number that's middle of the road. not try to like because you're going to have time to adjust. I've seen you do this with your girls' 529s. Like, they hit age 5 and you're like, holy cow, market did well. Maybe I should adjust. And then they get to 10 and 15. You're going to have chances to make adjustments all along the way. Just make sure you're not prioritizing that over all of the other financial matters that you should be doing. If you want to know what those are, go download our free deliverable, moneyguy.com/resources, and check out the food to figure out, am I doing all the stuff that then allows me to start doing the 529 and saving for college?
Yeah, Greg, I consider this funding kids' education to be step 8 of the financial order of operations. That prepaid future expenses, that's exactly where it is. And that's why even when you go download that free deliverable, you'll notice the cap. That's right there. There's a reason we use that education icon.
Yep.
Because we were thinking about the kids on that one.
That was a great question, Greg. All right, this next one is from Griffin. Griffin said, my company 401k offers 100% match on the first 10%. One, if I'm misreading that, if that's accurate, that's amazing, right? 10% match.
There's a catch. I know, because there's several technology companies that do this. Because I get excited.
Tell me more.
They do 10%, 100% match on the first 10%, up to $2,500.
Oh, okay, got it. Maybe that's the case.
I bet there's a dollar cap on how much that money
Either
is.
way, that doesn't kill the question. Here's the question. I've been doing Roth for a few months, but should I ask them to roll the match into Roth? If so, how often? I'm 23 years old. I have an $85,000 salary, and I'm 31%. That's a marginal rate in California, right? Yeah. So 31%. So here's the question. Some plans will allow for what's called in-plan Roth conversions, where I can take pre-tax dollars and then convert them to Roth. Well, we know how much we love Roth dollars for our young folks. So a lot of young folks start to say, I'm going to do my salary deferrals all Roth. I'm not going to get a tax benefit now. I'm going to get it in the future. So they just start piling money in. But we know the employer can't put money in the Roth bucket. Employer contributions have to go into the pre-tax bucket. Yet.
Keep going. I'll explain what I mean
Employer
by
contributions right now have to go into the pre-tax bucket. But some plans say, hey, we'll let you convert that. If you want your employer match to be in Roth, we'll let you do that. So it sounds like Griffin is in one of those plans. Should he be doing that? Is that something that someone ought to consider doing? And how do you decide? How do you figure out if that makes sense?
Well, I bet Griffin is asking this question because I saw the news media was covering some of this, is that there's legislation that's been proposed out there that would actually, I guess the government would bear the cost, is because they would allow let employees determine do they want it to be tax deduct, Roth versus traditional. And and this is also tentative. It's not even worth really discussing yet, because until things make it through both sets of legislation, the legislature, meaning the House and the Senate, because there's a lot of sausage making and horse trading that they do in between those things. I don't think it's worth really discussing, but there does appear that there's a push in Washington right now to give more funding options to young people to even get that portion to be deductible. But until that happens, until that legislation gets a little further along, Bo's discussion, and look, even to do Roth conversions in plan would mean you have a plan that's probably pretty forward looking, because you've got, when I see in-service distributions or in plan conversions, I know I've got somebody in HR that's somewhat of a financial mutant and knows some of the unique planning opportunities with the mega Roth conversions and so forth. But Griffin, you need to pay attention to, what is your tax rate? If you're in a very low marginal rate and you are young and you're one of those hyper savers that's, maybe you're part of the FIRE movement or something like that, and you're in the low tax bracket, it's not the craziest thing, but I am worried, because a lot of people who work for these forward-looking companies, they're usually technology companies, they're usually in high-income situations. Take advantage of the Roth, but also pay attention to the marginal rate factors out there, because that comes into play as well.
I think that what Griffin said is 31% in California, right? And so, but he also told us his salary. So it's really interesting. I don't know, Griffin, if you are married or single. But either way, if $85,000 is either your income or perhaps it's household income, one thing that tells me is that's below Roth contribution limits, right? So one of the things you can do is you can contribute directly to a Roth IRA. So we know that you can put $6,000 in a Roth IRA, assuming you're not married and your spouse's income puts you over the limit. You're also putting money in your 401k into the Roth salary deferral portion. So you have a lot of Roth dollars going to work for you. Now the question becomes, if I'm only 23 years old, I have a lot of years that things might change. Circumstances might change. I might be in lower tax brackets in the future. I might move to a different state. I might get married in my bracket change. Whatever the thing is, I don't know that I would be in like a huge hurry. And I'm just kind of thinking through this because this is a little half-baked. I don't know that I'd be in a huge hurry to accelerate all the taxes that I can into this current year, right? You're already making the decision to accelerate some taxes by doing Roth 401k contributions as opposed to pre-tax. And we would argue, our rule of thumb states that, once you're over that 30%, pre-tax is really, really attractive.
Well, especially in a state like California, because I know they have a higher tax rate state. I would definitely, because you just said something that's very important. Don't even consider doing this, converting traditional of your employer, if the plan allows it, into Roth, if you haven't done both. Meaning, if you haven't done the Roth IRA plus the salary deferrals already to Roth, that's a pretty good threshold. I mean, even on an $85,000 salary, I mean, if you think about those numbers, I mean, we're getting into close to $27,000 would be in Roth. So that $27,000 out of $85,000. That's a
big
savings rate. That's really incredible.
And I would encourage you, Griffin, if you are that person, go to moneyguide.com/resources, go download our wealth multiplier deliverable and see just how powerful those dollars will be for a 23-year-old all the way into the future. You are a financial mutant in the making, and I can't wait to
young age too.
Continue to watch your journey progress.
Literally a billionaire of time, with the seconds, and then saving that level.
It's unbelievable.
He's going to be a beast.
All right, Brian, here's a question. This one's near and dear. I'm hoping you have a story to tell because I've got some stories to tell on this. And this is from Jacob. Jacob says, I'm 24 and I need to have surgery.
Okay.
I save 25% plus, and I have money in my HSA and my emergency fund. Should I use part of my HSA to pay for this or use my emergency fund? I think a lot of financial mutants approach this problem. Well, first, Brian, let me set you the table for you. Why don't you explain really quick, very quickly, super, super quick, what is an HSA and what are kind of the three ways that people use them? And then talk about, with financial mutants, oftentimes we run into this problem that we think, okay, well, that money is sacred. I can't ever touch it. But sometimes it might make sense to use that for medical expenses as they're incurred. Can you run through those things?
I even had, and look, it depends upon how elective this surgery is. If it's obviously something that you don't get to be a decider of time, we'll get into these other things, but we talk about this all the time with like when you're planning to have children and other things.
Yep.
There's nothing wrong with paying attention to when your annual enrollment dates are, because every employer has an annual period where you can actually update your insurance options. And some plans, especially if you work for big companies, they offer the loaded up plans, the PPOs, and other things where you just pay the copay and you have much lower deductibles and other things. And then you have the health savings account, which we love health savings account as long as you're not really needing to use the money, because the problem with health savings accounts plan is that they have to have a high deductible insurance plan attached to them to make those deductions of the contributions work. So there's nothing wrong with also first decision is, can I be strategic with what's going on? I mean, this isn't a perfect analogy, but I worked for a company that I was able to, through the flexible spending account, the FSA, that's different than an HSA because they don't usually coexist. But it is one of those things. I didn't get my LASIK surgery until I waited until, I knew I had that plan that I was going to be able to really get the better option there. So that's the first thing, Jacob, is first, what type of company do you work for? Is your cafeteria plan have multiple options? And if you can be strategic with the election of when you have this procedure done, maybe you wait until after your annual enrollment and switch over to the other plan. If there's not a, waiting period or anything. I can't imagine on group insurance there would be, but I just feel like I need to put that disclaimer out there. So then we'll move to the next part of what Bo was talking about, is what are the three ways you can use a health savings account. We love the fact that these things are triple tax advantage. I brag about it constantly. Triple tax advantage means that you get a deduction when you put the money in for yourself. You also get the ability for them to grow completely tax deferred, meaning if you choose to invest the money, it grows tax deferred. And then if you use it for qualified medical expenses, it actually gets distributed out tax-free too. That's the triple tax advantage. And then if it's in your employer plan and they allow you to make those deductions with payroll dollars pre-tax, there's actually a fourth. There's a quadruple tax benefit, as you could avoid some of the Social Security and Medicare taxes as well. But realize most people, only 4%, I believe, actually use the full triple tax advantage, because most people are using this as a clearing account. They take the deduction, they put the money in, they take the deduction. They never actually build the money up and invest it. They use it just to clear it in, clear it out with current year medical expenses. If you're in a situation, I love really getting the triple tax advantage, but I also understand if this is a big medical expense, there is the why. The why component comes into play is that I would much rather you get into your health savings account using it for what this is actually for, the qualified medical expenses, than blowing up some other portion of your money, because I don't want you to, no reason to drain your emergency reserves down to zero if you have this money that you could, because, so many bankruptcies and other things are caused by medical issues. And I just would hate for you to run yourself so lean that you get yourself in a desperate situation, because that's the thing I always tell people is that bad news, because the bad thing is volatility, as well as you losing your job, real estate market getting crushed, all these different components, they're extroverts. They all hang out together. They party like rock stars together, and they wreak havoc on us all because these bad news things don't happen in a vacuum separately. It's not like, real estate market collapses, wait around for unemployment issues to go away. They all kind of happen in together. So just be careful, because I don't want you to get on shaky ground, Jacob.
And look, here, sometimes cash flow is just tight, right? Yeah. Like when we're early in our, especially if you're like the messy middle and you got all kinds of stuff, or maybe you're pretty messy middle and you're at the early stages of your career, there's just not a lot of money laying around. So oftentimes, maybe you are someone who's been maxing out that HSA and those dollars have been growing but a few things hit all at once. You're like, gosh, I got this surgery coming up. I've got this major medical bill. And man, it's just going to put me in a tough spot if I try to pay for it out of cash flow. So I have these two options, right? I've got my emergency fund that you laid out, and I got my HSA. Well, I think one of the things you have to do is look at the size of those accounts. If you're someone who has a lean emergency fund, maybe you've only got 1, 2, 3 months of expenses in there, but you have a healthy HSA account that's just kind of sitting there growing, yeah, maybe it does make sense to use that HSA, especially if you've got some earnings in there because you're capitalizing on the tax benefit, distribute it out and use those dollars. If, however, you're someone who has like a very robust emergency fund, maybe you've got 6 months or 6 months plus and it's larger than your health savings account, yeah, it's okay to use some of those emergency dollars. You have to kind of look at your unique and personal situation and figure out, okay, what is going to be the highest likelihood of me pulling money out and not having long-term detrimental effects to my financial well-being? And after I do that, how quickly can I work back up the financial order of operations? Meaning, if I do pull it out of my emergency fund, how quickly can I get that replaced? If I do pull it out of my HSA, how quickly can I get that money put back in there for this year's contributions? Being
a financial mutant means you become very good at the incremental decision making. Previously on this Q&A show, I had talked about that I had $10,000 I didn't do in Roth IRA funding because I was starting the company. Look, that was an incremental decision. I didn't have the money. It does have a cost because I didn't fund that. But does that mean that I'm so much happier that I started the company? Meaning, if you compare those two incremental decisions, the growth of my business is worth more than even the opportunity cost lost. But however, if I'd used that money for buying a car or doing something like that, that would be an incremental decision that would have been a huge negative. Your health is probably the most important thing when you're talking about incremental decision making, because no money is going to be created in the future if you don't stay healthy. So I look at it, you got to keep the machine healthy. There's a reason when we talk about, as you get older, respect what you got going on. I've heard Warren Buffett talk about the fact you get, basically, if you only got to choose one car for the rest of your, you get to choose any car out there and it's going to be paid for you. But the problem is you have to drive it forever. It's the only one you get. He's talking about your body. It is the vehicle we use to go through life. Respect it, be good with it, because the other stuff doesn't matter if you're not keeping that healthy. So pay attention to that, because I think that big, the incremental decision making is you have to choose what is going to ultimately give you the best result.
Another thing, and this is, again, I love having the live chat because Slayer Dork just reminded me of two things I think that are worth mentioning. Most people don't realize that medical procedures and medical stuff in general is oftentimes negotiable. Either one, you can negotiate the price depending on what the procedure is and what kind of consumer you are of the procedure. And two, there are times where you can do some sort of payment plan, right? Now, if it's going to be like interest bearing and interest accruing, then that's not great. But maybe say, hey, right now, I want to do this procedure. Can I pay you over the next 6 months, next 8 months, interest free? You might be surprised to know that the providers, in order to have you be a consumer, are willing to do that. So always have that conversation on the front end, or say, hey, if I pay this in full today, can I get a discount? You actually have the power as a consumer to do those sorts of things. So that was a great question. All right, here's the next one, Brian. This is from Punch King 123. Must be either a boxer or someone who really loves punch. I hear the advice to consider your marginal tax rate for deciding between Roth and traditional. Where does effective tax rate fit in? Here's the real question I like, and I want to talk a little about this. I'm thinking about things like the child tax credit and other credits or deductions. It's a really interesting idea, Brian, because we talk all the time about, if you make less than 25% marginal, you should think about Roth. If you make over 30% marginal, you should think about pre-tax. If you're somewhere in the middle, it gets a little gray. But there are times where, or there are certain tax benefits where if you cross $1 over, it goes away. Or if you cross into that next level, you trigger a different type of taxation, or you cross into a different marginal tax bracket. When you're making financial decisions, how do you approach those? And how do you think about those? Or do you not worry about it? Do you not think, especially like refundable credits, is that something that should be on your radar or should not be on your radar? If we have stimulus programs, is that something we should think about from a tax perspective, or just completely ignore altogether?
I feel like today the theme is incremental decision making, and how do you become a good decision maker with your money on the critical thinking skills. Both of these marginal rates, meaning according to the government, and you can do federal plus your state and local taxes, what is the taxation on that very next dollar? That's kind of what marginal rates are. Effective rate is you take your total income, you compare to what you paid in taxes, and you kind of just divide it out, and it just gives you an average of what your rate is as an average that you paid on your taxes. The reason we focus so much on marginal is because that's where the incremental decision making is. The average just doesn't. It's a good data point to know, but you really need to be thinking about your next dollar, because that also ties into everything Bo just talked about. Is that, and this is really when we have clients say, man, when do you really get to stretch and show your knowledge? A lot of times it is in that retirement implementation plan, is because there's so many tripwires. And that's exactly, that's why we can say, jinx, is because we know what each other are going to say, because we deal with this on a daily basis, is that you better know. And for a younger person, I'll bring it back to child tax credits and deductibility of student loan interest and things like that. Even rental property, because you make too much, you're not going to get that huge tax deduction every year that they tell you you'll get with rental property. But for older folks, you better know where Social Security is taxable, or where it gets to be tax-free versus 85% taxable, where the Medicare
surcharges.
Well, you can do Medicare premiums for retired people, for working class. You can think about Medicare surcharges at 3.8% on your capital gains and other passive income sources. You better know where all these variables are. So every dollar that comes in your possession, you can say, what are the tax impact for that next dollar? Because that's what I kind of go through this whole filter checklist in my head when I'm looking at income. I go, okay, I know that next dollar is going to be taxed at this level, and I better look at the federal rate, federal marginal rate. I better look at the state marginal rate. Do they have local income taxes? Let's put that in there. And I say, okay, what's the next tax rate marginal bracket, or where's the next marginal bracket down? Because maybe there's some behavior I can do that lowers me down to get below it. And then I start thinking about all the tax credits, all the deductible interest that have income phase outs. And then I say, how close are we to these things? And can I, through incremental decision making on the way I do my financial behaviors, push my income down, or do I need to be aware of this so I don't go $1 over? It's like Price is Right, where this thing goes away completely and you lose. I know, and this is what I hate talking to financial meetings about. This is why we are nerds. I mean, this is because this stuff, I think the typical person, their head has already exploded. They've cut this highlight clip off because, holy cow, what is he talking about? But this is the part of being a financial mutant. You have to do your homework and kind of know where all those things are. Because Punch King, literally, you will feel like you're punched in the head if you're not paying attention to all these variables. And that's why I always tell people, I want you to keep your financial life as simple as possible. But I know it is going to get complicated just through your success. I mean, that's why people go, why would you hire a financial planner? And I'm like, I mean, I'll just buy VOO forever. And then I'll just, these financial planners, they're ripping people off. And I'm like, oh, just wait. Just wait. It's going to, because you're not going, if you just watch this highlight clip of all these factors that come your way, you're like, man, I need a co-pilot on this. And that's the part that Punch King, I hope I've at least have given you enough breadcrumbs so you can start doing your research. But this stuff does get detailed and has a lot of variability to it.
Here's, this is just a little tidbit. What's so sad is that a lot of folks don't think about this until it's time to file their taxes. Well, oftentimes when you get to April or March or April of the following year, there's not very much stuff you can do to go back in time and change it. So if you can be proactive, if you can start thinking towards the end of the year about, man, what's my tax rate going to look like? What's my AGI going to be? What's my taxable income going to be? If you can start thinking through that, you still have enough time in the year to make some decisions that can affect that. We saw this a ton a couple of years ago with the stimulus payments and folks who were like right on the edge and not on the edge. And, it might have made sense to switch from, Roth contributions to pre-tax contributions to drive down income to qualify for additional. If you really want to be a financial mutant, you kind of have to think through that, but you have to think through it early. You can't wait until the last hour because odds are you're not going to be able to go back and change that or affect that. All right, Brian, this next question is from Brandon. Brandon says, my company contributes 8% of my income to a pension fund. I don't put anything into the fund. However, it's tied to the 30-year treasury. How do I count that in my savings rate? We get this all the time from either folks who work for companies that have pensions or maybe government employees. Hey, I've got this pension going on. How do I account for that? And I'm going to ask you two questions, Brian. How do I account for it in my savings rate? And how do I account for it on my net worth statement? Is it part of my retirement assets or is it not part of my retirement assets? And do you have a tool I could use to maybe track my net worth statement every year?
Yeah, you put a lot in that question. Here's the thing, Brandon, is that pensions are unique is because a lot of times they're just promises. Now, look, that I say they're promises because they're basically a promise of a future cash flow at some point in the future. But there is a little asterisk to that, is because a lot of times these companies will offer you the ability to roll the value of this pension over to an IRA or to your future employer's 401k or retirement plan. And when they do that, then it's a little different. It's not just a promise. It's actually something that might have an asset that you can do. It depends upon really how your employer has structured it. The first thing we'll answer is that, how do you account for this when I'm talking to you guys about your 25% savings rate? Where does that employer funding go? I mean, whether we're talking about 401k match, whether we're talking about pensions and other things, I always tell people, as long as your household income is less than $200,000, you can count that employer contribution as part of your 25%. But however, once your family household income goes over $200,000, I want you excluding employer money and only counting yours in that 25%. And the reason is we've done a lot of research and looked at it, and we've shown it in slides on several shows, is the more your income goes up, the more you separate from all the societal safety nets of Social Security, and all the different protections that happen if you just don't have a lot of resources. Because the more than likely, and I just read an article like on athletes and stuff like that, and how they all struggle even though they have all this money coming in through their life, that we all look at them and go, holy cow, those people make how much per year? Because I think that NHL's, average salary or minimum or something is around $2 million. I saw that when I was looking at it.
NHL?
I think that's where I saw that on a Twitter feed. I mean, it was some crazy thing. Maybe that was just the average for the league.
Crazy.
Maybe, but then they talked about that like over 50% of these professional athletes, when they leave the career, struggle financially. So it's a lot of people that have big income come with big responsibilities. So that's why I tell you, don't count employer money, count only your behavior once you're over those levels. But then here's the other thing, net worth. Bo was alluding to, I want you to start tracking what you have coming in. So that's why we do have a net worth tool. If you go to moneyguy.com/resources, you can start tracking. Remember, you can include pensions.
Go to learn.moneyguy.com for the net worth tool.
Yeah, that's right, because it's different. It's not on the free deliverables. It's actually one of the paid tools that we have. But it is one of those things where you can use, if they have a rollover amount or they tell you a value that you have access to, you can put that on your net worth statement, because that's what elevates it beyond the level of it's just a promise. Now, a lot of people will say, well, I'm trying to do some napkin retirement planning. I'm trying to figure out, where does this all play on how much assets I need? If I have one of those traditional pensions that doesn't tell me I can roll it over because it is just a promise, what do I account for there? What you need to do then is figure out what you estimate you need in retirement to live off of monthly or annually. Subtract out what the pension will provide you. You'll end up with your net need outside of pension and Social Security. Now you can back into how much you're counting on your assets that you've invested to create for you. That's a back way to calculate it or reverse engineer what you need. I feel like I've loaded Brandon up. Fill in any gaps I left off.
The only thing I was going to say is that is it okay to oversave, right? So let's say that you do have an employer that's putting 8% into a pension for you. Does that mean that you can back down your savings rate and live off of more of your income? Perhaps. Or you could continue to be a financial mutant and save 25% of your income. And what that's going to allow you to do is have more flexibility to make more exciting decisions earlier. If you're saving 25% and you can do that for the next 20 years, perhaps, depending on how your pension pays out, you're geared up for like an age 50 retirement instead of an age 65 retirement. Perhaps you can change jobs at some point in the future where you don't have to earn as much income. You can focus on doing what you want, when you want, the way you want, even inside of the work environment. I think there's nothing wrong. Now, there's a difference in being miserly, right? Don't just eat, ramen and Spam every night. Unless you love ramen and Spam, then, do that. But focus on, man, can I get myself out ahead of the curve? And that's okay. I just see people all the time, especially, I have a lot of friends that are, teachers or in the educational profession, like, I got this pension. I don't need to worry about the saving. It's taken care of. I'm like, you're missing it. No, you can set yourself up so much better by being a financial mutant early, letting those dollars work for you, and your 40, 50, early 60-year-old self is going to thank you for making those decisions instead of taking what I'm going to call sort of the easy road out and relying on the pension.
What you're saying is, because, when you're young, you have extra time. You take that as turn that labor into money, because you don't have a lot of money. In the future, if you do this right, you can take some of that money and get to own your time again. And that's really what you're going for. That's doing what you want, when you want, and how you want, is you own your life completely, because you have enough resources, you get to use your time however you please.
So Brian, I promise I did not do this on purpose, but wait till you hear this segue on this next question. This is from Truman. I'm pronouncing that wrong.
So is it not spelled Truman?
It is, but there's an extra M before the last M. So it's Trumamn. True.
Okay, whatever. Keep going.
This is Mr. Misfelt.
We're good at math.
How do I make sure to not live like a miser? I'm 21, saving 50 to 60%, but I still find it hard to part with any extra cash. How can I change my mindset? I think a lot of financial mutants fall into this. Now, often it's not 21-year-olds. We often see this for folks who are a little bit later on in life. But some people get so addicted to it, right? 50 to 60% saved at 21 is amazing, right? That's unbelievable. But if you're having a hard time like parting with any of your dollars, what advice would you give to them?
I mean, I think first there's an exercise you need to do. You need to, and this is one of the things we're working on with some stuff behind the scenes right now, is have you asked yourself what brings you happiness? What do you actually, if you could, I see people all the time post stuff on the internet where they'll say, you just got $100 million. What do you change in your life? And use that as a jumping off point to say, okay, would I travel more? What would I do different if money just wasn't that important to this whole decision making? Because I do think, like, are we going to promote next week's show at all? Are we going? Because I mean, like, we have somebody coming in.
The content team is shaking their head. Yes. Let's
so can I
promote it.
say his name?
Content team. Yep.
Okay. So Clark Howard's coming in next Tuesday for our live stream. So by the way, so instead of doing a normal just episode live stream, we're bringing in Clark Howard. He is part of my origin story with how I got into doing the podcast and so forth. I can't wait for you guys to hear this. And we booked Clark a nice room. Clark has called and scolded us for booking him a nice hotel room because he had found, because he's a travel guru too, not only as well being good with money. And he scolded us because we could have rented him a motel on the side of the interstate that was significantly cheaper. And I looked and I know, because I know enough about Clark's story. He's loaded.
Yeah.
I mean, Clark is not hurting for money, but he gets a ton of value and enjoyment. I think he actually enjoys, making good financial decisions. So if I asked him what makes him happy, it in that hotel. It is, being good with money and traveling. He's more of the quantity over the, some of these other things. So I think that's what you have to ask yourself, because if you are miserly, if you're doing something at the expense of your best life, meaning with happiness balanced out with the cost of resources, but if you're finding that you just don't, because you can, like, that's the biggest thing about becoming wealthy I have found is like, I see all these influencers and they're buying Lamborghinis and McLarens and stuff like that. I know more than the man in the moon want that right now. And I could go buy that or even, or these other things. And I'm like, why? I mean, it just doesn't, it wouldn't bring me any incremental. It's more about the flex of showing you have it. And that's just not what I get. I'm not an ego type person with what I can do with the money. And I think that's probably what Truman is struggling with, is that as you get resources, you better really do that exercise on why. That's why when we do the 5 levels of wealth, you'll find once you make it past the incremental, can I provide shelter for my family? Can I feed my family? Is my career providing enough, or my assets providing enough that I don't worry about the basics? You can find out money is it's more of a tool so that you can live your best life. And you better start doing those exercises. That's why we're always talking about the financial mutant stuff, so that you can enjoy those decisions. Because there's a balancing act when you're young. You better get those resources working, because time is the most valuable resource. But you're going to get to a point of success where you say, hey, yeah, it will grow more, but you can't take it with me. So I better make sure that we're also building the other parts that you can take with you, which is the memories, the experiences, and also leaving that legacy with your family. Pay attention to those things, because there's a balancing act, and happiness drives a lot, or fulfillment drives a lot of that, because you don't want to be on your deathbed and going, man, I never got to go see that great wonder, or I never got to do that great experience, or I never got to do this with a loved one. That is the stuff that makes me sad. So make sure you're taking that into account.
All right, so I'm going to play. I agree with everything you said. I'm just going to speak to the other side of that coin a little bit. I am not significantly. I'm not so much older than Brian is, but I'm still older than you. And here's what I know. My 21-year-old self, I just didn't have life figured out, right? I didn't know what family was going to look like. I didn't know what state I was going to live in. I didn't know what career was going to look like. There are a lot of things in life that are likely going to change.
Oh, yeah.
So early on,
Yeah, go ahead.
early on, when you're 21, I don't think you have to have it all completely figured out in terms of, oh man, I got to be spending this much and I got to be, I'm saving too much. I'm over saving. I'm not spending enough, because life will kind of have this natural way of grabbing on some of your resources, right? Like you get married, all of a sudden money starts kind of going away. You start having kids, money starts going away. You buy the new house, you move into the new neighborhood, you buy the new car, you fill in the blank, and your money kind of starts dissipating naturally over time. What you want to do is make sure you have this strong hold on it that says, you know what, I'm not going to drop below that 25%. It's okay. I don't have to go force myself to expand my lifestyle now to make sure I'm only saving 25%, so long as I'm not foregoing things that do bring me happiness, and I'm not foregoing taking the trips and doing the stuff that I actually enjoy. But I wouldn't spend for the sake of spending, because again, your 30, 40, 50-year-old self might think your 21-year-old self that built up that nice cushion of 50 to 60% savings when you could. I was able to do a lot of things a lot more cheaply when I was in my early 20s than I am able to do those things now. And I think that's okay.
Well, you said something that just triggered it, because it is so, you just don't know what the future holds. My 16-year-old self thought my 25-year-old self was going to go buy a Corvette the day I hit 25, because that's when the insurance rates would go down. And then my 25-year-old self thought that I was going to retire at 50 years old, because that's why I was saving so much then.
I hope not.
And now here I am, I'm quickly approaching 50, and I no more want to retire, because I'm having so much fun doing content, working with all of you, that it just is amazing how your future self, it will be changed and your goals will change. So that's why if you can go with the structure we talk about with the financial order of operations, incremental decision making, it sets you up so that you actually get more flexibility and you don't get railed into only one solution to your financial life. And I like that, because then it protects you from really sticking yourself in a bad situation. Because I do worry about the young people that are on the other side, the over-consumerism, because instead of having more options, they actually are squeezing themselves into, instead of choosing to work at 50, a lot of people, thinking if I would not have started saving, I would have to be forced to work.
That's right.
And that's, remember, you're actually using your resources to get more time. You get to, that's what financial independence and fulfillment is.
Love it. All right, Brian, this next question, this is from Financial Princess. It's a friend of the show. Now, I've been using TurboTax for years, and my spouse and I are now at a point where we're ready to hire a tax professional as our financial situation is becoming more complex. Where do you recommend I find a good CPA, and what questions should I ask? The where's a harder one. What questions I ask is interesting. I would love to hear you speak a little bit, though, Brian, to maybe some appropriate expectations to have when going from being a do-it-yourselfer to hiring a tax professional. Because I don't know how much TurboTax costs these days, right? $40.
Pretty cheap.
It's pretty inexpensive.
I think it might be free if you, in some aspects.
Yeah, and so I'm amazed when people, they talk about going to pair. They're just not prepared for the change that is there. You want to talk a little about that transition? And you can take this anywhere you want. When it makes sense, what question to ask, whatever kind of strikes you. But I'm just so amazed by, a lot of times there's this sort of shock when you go from a TurboTax person to a tax accountant filer person.
It is one of those things where I'd go ask people that you are aspirationally think that you will be in their place in 5 to 10 years who does their taxes. I mean, it's just like right now, there's an influencer that I would love to find out how they have their tax, who does their taxes. Just because they have a lot of commercial real estate. They also have, content creation. They have several businesses. I just love to go talk to who their tax preparer is, because that's probably going to give you a lot of insight into your life too. So don't just ask your friends and family. Also ask the people that are at that tier you think you want to be, or at that income or wherever it is. That's my question on how you go interview, how you find one. Now, the next thing is you have to kind of go into the relationship with the expectations, because TurboTax is great. I was a paid preparer. I was a CPA, did this for over 16 years, that I never Well, it's against TurboTax. Matter of fact, a secret that a lot of people don't know is Intuit not only owns TurboTax, it also owns Lacert, which is what a lot of your tax preparers, that's what I always use to prepare taxes. There was Pro Systems and then there was Lacert. I used both between the different firms I was at. And that's owned by Intuit. So, I mean, your tax preparer is using a very high-powered version of a TurboTax. I mean, it's much more because CPAs know the forms, so it's not, instead of going through, it would drive me crazy to do a tax return by going through all these questions like I know TurboTax does. Lacert and other professional software, they count on you to know where things go, so they let you, really move through things much faster. But it is one of those things, it's all about who's operating the systems. The biggest thing you're looking for with an accountant is, are they going to just check the box? Because that's what, you kind of go through the progression of TurboTax is you've gathered your shoebox full of documents, you're downloaded them, and now you're manually inputting it by going through their questions and answers. The next step up is kind of, you could go to your, what I call the convenience preparers. That's your old H&R Blocks and all these other preparers where they're going, whatever you show up with that day, they're going to prepare your tax with. It's not, yes, they're doing the input for you, but the data gathering or trying to figure out if there's extra solutions
kind of falls on you.
It's going to be minimized on their side, more on your shoulders. The CPA, the ideal is, now look, I will tell you, there are a lot of CPAs out there. I think they get themselves they start, because the problem with being a CPA is you realize you don't make more money unless you take on more work. And sometimes when you do a compressed season, that's what a tax season is that, you essentially have February 1st through April 15th to pile in as many tax returns as possible. They get overwhelmed in that period of time, and it does become more transactional instead of being a consulting relationship. Because what I always wanted when I was trying to provide for clients was, I was actually trying to look for additional deductions or find credits or other things that would hopefully add value, to the point that, I even tried to challenge myself. Could I find enough deductions to pay for my fee?
I love it. That's
I
great.
felt like I was a very good tax preparer because I did go into it with that approach, is that I was looking at it as more as a consultant to how I could help this client navigate tax preparation as efficiently as possible. But that's not the norm, and I think it's hard. So I think you just need to go interview CPAs, find out what their process is, what you can expect from them. Are they going to help you? Because they might tell you, yeah, I'm going to help you find that, but that's why I give you a tax organizer. Because you're going to go through that tax organizer, and it's going to have you questions, yes, no questions, transactions, and you're going to be like, wow, this reminds me a lot like TurboTax. Because here I am back in this narrative form again. So just pay attention to the data gathering and the expectations and how busy your CPA is. And look, if you're just doing a basic return, it might be transactional. It might be one of those things where, you go to the front office, or they email you, or they just send it to you in the mail. But if you get to be big enough, if you have enough going on in your life, it's not unreasonable, I think, to have expectation that you might meet with the CPA too.
Is it certain? Is it an absolute certainty that when you make the decision to hire a tax professional and you no longer prepare yourself, that you will pay less taxes than you did?
I'm glad you asked that question, because I know that who knows? This client very well still might be listening to all of our content, because she's just brilliant. And we got to the point, she had enough success that her and her husband wanted to hire a tax preparer, because we were like, you're so successful now, you got a lot of complications going on in your financial life, you probably should graduate from self-preparing. Hired a CPA, and then I found out she still was running a tax return in the background. She was still doing the tax on TurboTax, going to the CPA, and then doing a cross comparison to make sure. I was like, what are we doing here?
You're going to do the work anyway.
You're going to do the work anyway. Well, you might as well not pay the fee. So it is one of those things, if you're just such a financial mutant, because I've mentioned next Tuesday on our live stream, we have Clark Howard coming in. Part of that story of how I met Clark Howard originally, to the origin of this show, was I knew who prepared his taxes. We were college buddies. I think he's going to be in town too, so he'll probably get a shout out on that show. But he was very open with me, when we talk about, now look, he kept confidential. I don't know any of Clark's information, but the preparer would let me know Clark really is so curious on how this whole system worked that he wanted to sit next to me as I prepared his taxes so he could see all the input screens and that type of stuff. That is a unique personality that's probably not a great delegator and really gets enjoyment how knowing the why of everything. You might just be preparing your taxes for him. Now, I will tell you, if you are going to be a self-preparer, please maximize the resources. I want you to make sure you are using the TurboTaxes or whatever self-preparation software. Do not, because I found this, I mean, going back in the memory banks, I remember this attorney that did everything by hand. I mean, literally filling out the tax form by hand. That's crazy town territory there. Do not, make sure you're at least using the resources to help you do this process, because the last thing you want to do is get an IRS notification because of a computation error, meaning you just didn't add up something correctly, because that is the last thing you want to do, is get on a radar just because you knuckleheaded this thing up with you couldn't even add or subtract the right line. And those forms can get confusing on that. So know yourself and go into a reasonable expectations when you're hiring a CPA. How did I make this that long of an answer?
I have no idea, but it's like watching
I feel like Financial Princess is probably like, man, tax season is already over. Can we go ahead and start talking about 2022 at this point?
All right, here's a question, Brian. This one is from Vicky. Vicky says, I have over $1 million in my traditional IRA. I want to convert it to a Roth IRA. Should I go at it incrementally over years or do it all in 1 year so I can start earning some tax-free income? Now, I'll do the compliance disclaimer. Vicky, we can't give you any sort of specific advice here on the show. But Brian, why don't you talk a little about like what is a Roth conversion? What's she asking? And what are some things when we do this kind of stuff for clients that we sort of think through and we kind of look at and we think about?
Vicky, this is a great question. And I will tell you, you've already offered up how much you have. This is the part where you're essentially getting into abundance cycle graduation territory, because there's just a lot of variables that come in. But let's talk about this. So $1 million, good chunk of money. And, and what she's talking about is, we know that with IRA assets, they're unique in the fact that the government lets you put money into these IRAs with the understanding they grow tax deferred, but when you reach to a certain age, you're going to have what's called a required minimum distribution, meaning the government's going to force you to start pulling money out of these tax favored assets, and then you'll start paying income taxes on it. So there's this clock in the future. And by the way, it used to be 70 and a half. Forever it was 70 and a half. And then they fast forward to, or rewind just a few years ago, it changed to 72 years of age is where required minimum distributions. And currently there's discussion on legislation right now that would take that up to 75. So this is something that's in flux. But what I like to see, and did Vicky give us her age?
She did not.
So Vicky, what I like to see though is, because it's hard to do a lot of Roth conversions when you're in the highest marginal brackets, and we talk about that all the time. Once your marginal rate, meaning if you had your federal, what the next dollar will be taxed at, plus the state income taxes, plus any local taxes. Once that number is over 30%, you're like, wow, is there a chance that when I retire and I don't have earned income flowing in anymore, are my taxes going to go way down because I'm in a much lower marginal rate? And this is also why we love talking about, step 7 of the financial order of operations. You go moneyguy.com/resources, or even learn.moneyguy.com if you want to have the course on the financial order of operations, because we talk about the triple buckets that you need to have: the after tax, the tax deferred, which are your IRAs and so forth, and then even the tax free like the Roth, because they allow you, hopefully in retirement, that you can manipulate legally how much you pay in taxes. Because if you're no longer living off of your earned income, now you get to choose, especially if you're retiring in your 50s or 60s, before the government starts making you take those required distributions. You have a huge opportunity here to look at the tax code and figure out, hey, what's the most optimal way to pull my money? And there's several factors. You're talking about doing Roth conversions, but there's another thing. Let me start going through some of these variables you need to consider.
Sure.
We pay attention to also, is there a portion of capital gains that you can take Because realize the government has this crazy provision that if you make below a certain threshold, you pay a 0% capital gains rate when your income's low. If you're paying 0% capital gains, you need to take that into account. That's a very valuable thing. So that's the first thing. You're taking that into account. You're also taking into account, when do I start Social Security? Because that increases taxability. And you can start taking it at 62. You can do it full retirement age, which might be 67. Or you can wait until 70, because you know from full retirement age to 70, they're going to pay you 8% more per year. All these variables come in, and then don't forget you got Medicare. Medicare kicks in at 65, but they charge your Medicare premiums based upon your income in the past. So they're going to push your premiums up if you make too much. So you better take that into account. So that's what we pay attention to, the tax rates, and then all these outside influences that come into account, and then we figure out, is there a plan? Maybe there's a 3-year window, maybe there's a 5, maybe there's a 10-year window where under current tax policy we can convert $35,000 a year, or we can do $40,000 a year. And that's why, Vicki, I don't know your details. So, but it is one of those things where we try to think of it in terms of optimization, because I would feel horrible to tell you to go dump all $1 million into your ordinary tax rates, trigger all the different surcharges and other things because you blew past all the income thresholds, and then you have some regret on that because you essentially ate up 40% of that money almost overnight. You can imagine we're technicians, so we prefer to kind of optimize that strategy as much as possible.
If you are in this situation, Brian he started with this. This is a great time where it might make sense to take the relationship to the next level. If you haven't gone to check out the website, what we do in our day job, go to aboundwealth.com. We have, I would say, the best team of advisors in the whole world. Amazing advisors here who can help navigate what strategy actually makes sense for you when it comes to doing Roth conversions and how you should think about approaching that, because these things are very big decisions that have very long tails of implications. You want to make sure that you're making the right decision, you're making it well, and you haven't just measured once or twice, but you measured 3, 4, 5 times before you begin putting them into place. Now, all right, Brian, Seth asked this question, and it's, man, a lot of tax stuff today. I'm having trouble deciding between a solo 401k and a SEP IRA. I can contribute the max to either one. I'm also married, and I'm wondering which one is a better option. So, Brian, why don't you talk a little bit about what's a solo, what's a SEP, which one's better, and does it matter if you're maxing it out anyways?
Well, yeah, this is I love this question because this is so fun for me, because it takes me back down memory lane of helping business owners and even myself when you're making decisions, when you're an entrepreneur, you're trying to figure out, hey, what's the best retirement savings vehicle? It's usually a progression. And there's a chance. Now, look, I guess things have changed a little bit because these solo 401ks kind of revolutionized things. So you might jump on that first. But let me tell you where SEP IRAs, what their superpower is before I tell you really the awesomeness of these solo 401ks. SEP IRAs are those unique tools that, because I've shared my journey and I've talked to a lot of business owners who've worked with a lot of business owners. I know how hard that first 3 to 4 years is to get traction with your business. So to tell somebody who just started a brand new entity, hey, start funding that retirement account ASAP. They're like, what?
Are you kidding me? I'm trying to keep the lights on.
How am I going to fund retirement when I'm trying to just get this business off the ground? So it's just hard to allocate those resources in the beginning. So what I like about SEP IRAs is they are essentially a DeLorean that allows you to go back in time. They're one of the few unique where you can actually get a big benefit, tax benefit, in going back in time. What I mean by that is that you're a business owner, or you have self-employment income, or you have a side hustle, and you've got this income that's coming to you that's subject to self-employment taxes, or you took a wage in your company, if you're a sub-chapter S or something like that, and you get to the point and your tax preparer goes, whew, man, Brian, Bo, I know the last 2 or 3 years were a struggle for you, but you knocked it out of the park this year. Congratulations. Right now, I'm showing on paper, you owe like $30,000 in taxes. You're like, what? Oh, $30,000. You got to tell me, tax preparer, is there something I can do that would allow me to minimize that? How do I get that down, lower? I'm like, well, there is a tool that you can do. It's called a SEP IRA that lets you, right now, I can set you up a SEP IRA that lets you go back in time and lower, deduct it off of last year's income and actually lower your taxes. So potentially, if you owe $30,000 in taxes, there's a chance that, the government can fund 12 to 15,000 of this through tax savings.
Yep.
So they might, 40 to 50% of this could be funded through federal and state local taxes. Do you want to do that? Do you want to put some money in your SEP and then lower your taxes down that much? You're like, yeah, let's do that. So that's where the SEP IRAs, they are so powerful, but here's the caveats on that. SEP IRAs are only funded by the employer, meaning it is not your money, it's the employer's money. So if you started this company, it is your business or your self-employed opportunity that's going in, and everybody gets the same thing. So as soon as you start having employees, it typically blows this up because, yes, you want to put this SEP for yourself, but when you have to start putting 25% of compensation or 20% of compensation to your employees, you're like, whoo, this is going to get expensive really quick. Enter on the scene. By the way, SEPs are very easy to set up. So that's something. And by the way, here's another caveat, and I keep throwing things. Make sure you do, I think it's called a 5305, because custodians, I saw a case where the IRS went after an employer, a business, because they didn't have a copy of the 5305. What it is basically it's a form just letting the IRS know, hey, we're establishing this plan, and here's the eligibility requirements since this is an employer-provided plan. And by the way, here's the crazy thing. The IRS says, don't send it to us. You just keep this in your records.
Make sure you keep it filed.
Just keep it in your records. It'll be okay. Well, custodians, Vanguard, Schwab, Fidelity, I don't know who was the custodian for this case, but it was a large custodian, and they just set up the SEP IRA, did not require to see or get a copy of the 5305. Fast forward to the audit, and they ask, hey, you got the 5305, and this person was like, what's that? And, and they're like, well, they got a hold of a hard person that really pushed and squeezed, and they end up they didn't allow the deductibility on some of those contributions. That is the worst case scenario, but I'm just telling you, check all the boxes and be careful. So that's the whole SEP IRA. Very easy to set up, no annual filing requirements with the government, no 5500s or IRS requirements, but just keep good records for the past. Then came along solo 401ks. Solo 401ks are pretty spectacular in several ways. And the fact that they let you do the same thing the SEP IRA does, meaning that you get to do a profit sharing, because that's what a SEP IRA is. If the employer's the only one funding, it is essentially a profit sharing contribution, since the company has to have money to do it. The solo lets you do not only the profit sharing component, but it lets you do a salary deferral. And we know right now in 2022, that's $20,500.
Yep.
So you get to do that salary deferral. I mean, you get to do the profit sharing that the SEP does, plus the salary deferral. So you can and you can do and you can do a spouse.
Right.
So you can have you and your spouse. Now, if you have employees, you're not doing a solo 401k. So if you have employees, just throw that out the window. It doesn't work. You go to more of a traditional 401k. But solo 401ks let you do you get to stack the 20,500. You get to stack the profit sharing, and you can do all the way up to
61,000.
Is it 61,000 unless you're 50 or older, and then you get to stack on the extra catch-up contribution. But that is so powerful if you can do these things. But here's the catch on this. You don't get a DeLorean. You don't get to go back in time. So if you want to do a solo 401k, you have to set this thing up before your year end. So you have to be very proactive. Now, you get a little extra funding time on the profit sharing, just like a SEP IRA. But the salary deferral has to be run through payroll or attributed before year end. So that requires a lot more preparation. There's also the nerdiness of the fact that solo 401ks are very easy to set up. You don't require the 5,500s that traditional 401ks are required for a short period of time, meaning that as long as the assets are below $250,000, you avoid. By the way, pay attention, because compounding growth is such a powerful component that it doesn't take long, especially if you're funding it every year at that $60,000 mark. You'll hit $250,000 very quickly, and you better be filing that annual $5,500 at that point, or you could be like, whoopsie, and then get yourself, because the penalties are pretty stiff on that stuff. So pay attention to it. What did I leave off? Because there was a lot to cover.
Only two things that I think that I would add to that. When you're deciding how do you decide between the one, I would also think about other types of strategies you're employing. For example, if you're someone that's doing a backdoor Roth every year because your income is over the income limit, solo 401k might make more sense because you can still do backdoor Roths without running into the pro rata calculation. If you have a SEP IRA, your backdoor Roths will now start becoming taxable. So you want to make sure that you stay aware of that. Here's the second thing. Perhaps this income that you're generating is from a side business and you have a day job where you have access to another 401k. You only get one pot of $20,500 salary deferrals, meaning even if you have different 401ks, you can only put one $20,500 away. So a solo 401k, if you're going to do it and you have a day job, would only allow for you to make profit sharing contributions. So you kind of want to keep that in mind as you decide between the two. This is another great example. If you're trying to set up retirement plans, trying to figure out how to save on taxes, trying to take your finances to the next level, maybe you should also think about taking your relationship to the next level. Reach out to a professional advisor. We're always happy to chat with you. You can go to boundwealth.com, moneyguy.com. Check out the Work With Us page because this is a prime example of when it might make sense for us to have a conversation.
And this is because he didn't ask, but Seth, here's the cool thing. I talked about SEPs. They're super easy to set up. They're low cost. Solo 401ks kind of revolutionized the self-employed game. Here's the good news. Because of all the pressure and the competition, when you graduate beyond solo 401ks because you get employees or your assets get too big, traditional 401ks or safe harbor 401ks, however with custodians and third-party administrators, have gotten so much more affordable than when I first started getting in the industry in the 90s. That it's not even scary when you graduate beyond even the solo 401ks. And it's just so exciting. I love these tools. I love what we do for a living because this is the part where we do get to show the value of the abundance cycle, the value of working with nerdy people that know all the ins and outs of this stuff so that you can feel like every dollar is getting maximized, but you're also building the best version of your financial self for the great, big, beautiful tomorrow so you control and do your time. Go ahead and let abundance cycle be fulfilled. Learn, apply, grow. We know you stick around enough. You're going to need us at some point, and we'll be here. aboundwealth.com, moneyguy.com. Check on the Work With Us. Bo, you always throw a few shout outs. We can do moneyguy.com/resources.
Yep, we go to our resource page. If you're not following the blog, we now have a blog, FYI by FTE. Daniel's writing that blog. It is fantastic stuff if you've not checked it out. And then we're on all the socials. Go check us out on Twitter, on Facebook, on TikTok, on Instagram. We did a really cool Instagram Live March Madness tournament. Oh, yeah. We made it all the way to the finals. So if you're not following us on social, you're missing some of that fun stuff. Make sure you guys go check all of it out.
Yeah, by the way, thank you guys for coming in. I was surprised to see in the comments rolling through while we were doing that Instagram competition. You guys showed up, and it made us feel good. And I think we kind of surprised some of the people who weren't aware of who we were. We're like, watch out for that Money Guy team over there. They're trouble. Guys, thanks so much. I'm your host, Brian Preston, Mr. Bo Hansen. Money Guy team, out.